Welcome to part 5 of our chapter 6 discussion. So on the last video, we finished up our comparison of absorption and variable costing and comparing their net operating incomes and doing the reconciliation. So now we're just going to look at a summary of the comparisons of the two, and we'll finish off this video discussing just a couple of other points. So when the number of units we produce, when that is the same as the amount of units we sell, then we have no units left over from what we made. In that case, there's no change in our inventory. So no inventory left over at the end of it, and no old inventory having to be sold to make up for not enough being produced. So when your number of units produced equals your number of units sold, the net operating income under absorption costing equals or is the same as the net operating income under variable costing. And why is this? Well, simply because no fixed manufacturing overhead in this situation is deferred in inventory or released from inventory. So the same amount of fixed manufacturing overhead is flowing through to the income statement under both these methods when the number of units produced equals the number of units sold. However, what about when the units produced versus sold are not equal to one another? What happens in that situation? Well, when the number of units produced is more than what we sold, then that means you're going to have units left over. And when you have units left over, the effect it has on inventory is to increase inventory if you have units left over from what you made in this period. Well, if you have units left over, remember those units under absorption costing, each of them not only have variable production costs attached to them, but they also have fixed manufacturing overhead attached to them from the period. So under absorption costing, if you have units left over, they're going to have fixed manufacturing overhead attached to them that is not going to immediately flow through to the income statement. Whereas under variable costing, all fixed overhead flows through to the income statement because it's a period cost. So when you have units left over, then that causes you to have fixed manufacturing overhead cost deferred in inventory under absorption costing. So in that case, there's less cost flowing through to the income statement under absorption costing than under variable. The less cost you have flowing through, the larger your net income. So if absorption costs, if this income statement under absorption costing has less cost on it compared to the variable costing income statement, it's going to have the higher net operating income. So when your units produced are more than your units sold, the absorption costing net operating income is going to be higher than the variable costing net operating income. Now, when your units produced is less than the units sold, how can that be? How can I make less than what I sell? So what about when units produced is less than the units sold? Well, for this to happen, if we're selling more than what we made, we're going to have to end up selling whatever inventory we have left over from the previous period, any beginning inventory left over from last year or the previous period. So when you produce less than what you sell, you're not just selling everything you made in the period, but you're also selling older inventory from last period. Well, when that happens, your inventory decreases, right? Because not only are you selling everything that you made, but you're also having to sell some of that beginning inventory. So that decreases your inventory. In this case, though, when you sell everything that you make and then some, those older inventory units, all of those are going to have fixed overhead attached to them from the previous period. So under absorption costing, not only is all the fixed overhead from this period flowing through to the income statement because you're selling everything that you made, but also old fixed overhead from last year is also flowing through to the income statement under absorption costing since you're selling those older units as well. In this case, not only is fixed overhead from this year, but fixed overhead from last year is also flowing through to the income statement under absorption costing. This means more cost is flowing through to the income statement under absorption costing, where under variable costing, it's the total fixed overhead from the current period that always flows through as a period cost onto the income statement. So in this situation, there's more absorption costs or more costs under the absorption costing system than under variable costing, causing that income statement to show a smaller net operating income than under variable costing. So when your units produced is less than the units sold, absorption costing is going to show a smaller net operating income than under variable costing. So let's take a look at enabling CVP analysis. So remember, one of the major motivations behind using variable costing is that it enables us to do the CVP analysis that we learned about in Chapter 5. Break-even analysis, target profit analysis, CM ratio, and so on and so forth. So remember, variable costing, it categorizes costs into their cost behavior categories, either as variable or as fixed. So when it's set up in that way, we can conduct CVP analysis. Okay. Now, under absorption costing, we inventory our fixed overhead. So the fixed overhead is assigned to those units that we produce. So any unsold units at the end of a period will still have some of that fixed overhead attached to them and sitting in inventory. So what this can end up resulting in is it could likely cause the net operating income under absorption costing to look positive, for it to come out as a positive number, whereas under variable costing it might be a different story. So even when you're below break-even point, under absorption costing, it's possible, depending on the situation, to show that you have a net operating income, where if you were to calculate those same numbers but using the variable costing, we know if it's under the break-even point, you're operating at a net loss. So because absorption costing inventories fixed manufacturing overhead, it's possible to sometimes get a skewed view of actual profitability. So it's just important to keep that in mind. Although remember, absorption costing, it's the traditional method and it's what we have to use under GAAP. So the variable costing is only for use by managers. And why would we use absorption costing? Why is it required by GAAP? It all goes back to the matching principle. We want to properly match all of our revenues to the expenses. And by inventorying our fixed overhead, we're trying our best to match that cost to the sale that it will help generate when we finally sell that unit. So that's the logic behind GAAP requiring the use of absorption costing for external reporting. Explaining changes in net operating income. So we know also from Chapter 5 that variable costing income, or the net operating income, it's only affected when the unit sales change. All other things held constant. It's not going to be affected by the number of units produced. So even from last chapter, we saw when sales go up, your contribution margin goes up, and when your contribution margin goes up, so does your net operating income. Absorption costing, on the other hand, it's influenced by changes in unit sales and units of production. So when sales change and the level of production changes, absorption costing is affected, because remember, you use the number of units produced to assign fixed overhead to your units. So under absorption costing, you can increase your net operating income by just making one more unit, even if you don't sell it. Because why? Well, if you make a unit and you don't sell it, remember, a part of that fixed overhead for the period is attached to that unit and will be put away into inventory until it is sold. So you are essentially deferring cost from flowing through to the income statement if those units remain unsold. And then finally, the last note for this video, supporting decision making. So remember, absorption costing is necessary for external reporting, but variable costing, it's very useful for managers, so for internal purposes. So if we have to use absorption costing, why would we even keep separate books to use variable costing? Well, variable costing, it correctly identifies how much it's going to cost to make one more unit. because remember, it only looks at the variable production costs, and variable costs by definition are variable with respect to changes in activity if we're looking at the total amount, although the per unit amount will stay the same. And with variable costing, we're also able to look at the impact that fixed costs have on the bottom line. So the contribution format income statement really enables extra analysis and deeper analysis into those elements. Now, with absorption costing, remember, I'll say again that fixed overhead is an inventoriable cost. So it's put into inventory by attaching it to the units we produce. So, but that makes it look like fixed overhead is variable with respect to the number of units produced, but we know it isn't, right? Because a fixed cost, by definition, it's fixed. We can convert it to a per unit amount, that's fine, but the per unit amount is only applicable for that specific period because the number of units we produce can change. And it makes it look like for every extra unit I make, I'm actually incurring more fixed costs, which you aren't. In total, it's a fixed amount, but we can look at it from a per unit perspective if we want to. But by assigning that fixed overhead per unit to every unit produced, it makes it look like it's a variable cost, just like the variable cost of goods sold is, but it isn't. So if a manager doesn't quite understand that and doesn't make sure to remind himself or herself about that, it can cause managers to make inappropriate pricing decisions, or they might even decide to get rid of a product line or a business segment when looking at it from the absorption costing perspective, when in reality it might yield different results when you're looking at it from a variable costing perspective, when you're actually then breaking up costs between their variable and fixed cost behaviors.